Trump says U.S. to help free up ships in Strait of Hormuz starting Monday. The leverage shift starts now. Here is the signal that separates noise from actionable change. We will map trigger, incentive shift, and downstream impact before the close. Trump just announced it. This is not a drill, not a routine patrol, and not a statement. This is a direct military escalation in the world's most critical shipping choke point. Here is what changes in the next 72 hours. The Strait of Hormuz is the pipeline through which roughly 21% of global oil passes every single day. 21%. That's 22 million barrels flowing through a 21-mile wide passage every 24 hours. When ships get stuck there, energy markets move. When energy markets move, inflation expectations shift, currencies adjust, and portfolio risk recalibrates. Trump's announcement changes the probability of what happens next week. Why is this happening right now? Tensions in the Persian Gulf have been escalating for months. Houthi missile attacks on commercial shipping, Iranian provocations, and U.S. carrier movements have created a pressure cooker. Ships have been rerouted, insurance premiums on Gulf routes have jumped, and energy traders are pricing in supply risk. Trump's decision to move forward with a dedicated Navy task force is saying, we're going to change the math. We're going to reduce friction in the strait. We're going to make sure oil flows. So what does this mean for markets? First, crude oil prices are sensitive to disruption risk. Brent crude has been trading between $75 and $85 per barrel this week. A credible U.S. military presence in the strait actually reduces tail risk, the risk of a sudden blockade or attack that could spike prices 30 or 40% overnight. That's stabilizing. Second, shipping insurance costs will likely compress. Underwriters price in geopolitical risk. If the U.S. Navy is actively patrolling, that risk premium shrinks. Shipping stocks, firms like Frontline, Navios, and various container operators, benefit from lower insurance costs and faster transit times. That's not huge, but it's measurable. Third, this is inflationary commentary from Trump. Lower energy volatility means more predictable commodity prices. That actually helps the Fed's narrative that inflation is under control. You might see a modest USD strength move on this announcement because it reduces oil shock risk. But here's what nobody is talking about yet. Military escalation in the Persian Gulf is also a signal. It's a signal that the U.S. government believes the risk of conflict in that region is material enough to warrant permanent naval presence. Markets love clarity and stability, but they're also watching geopolitical tail risk. If this move becomes a permanent fixture, it suggests Washington sees Iran or regional actors as a persistent threat. That's different from a 3-week show of force. A permanent presence means the U.S. government is betting that tensions won't cool anytime soon. That changes how long-duration energy contracts are priced. Here's what to monitor over the next 72 hours. First, watch crude oil futures. Does Brent drop on the Monday announcement, or does it hold steady? A drop would signal that markets are pricing in reduced disruption risk. A hold or a spike would signal skepticism, that traders think the military move either won't matter or could escalate tensions. Second, watch shipping stocks and insurance indices. If insurance premiums on Gulf routes compress, you'll see that reflected in shipping company earnings estimates within days. Analysts will revise their numbers. Third, watch Treasury yields and the USD. If this announcement reduces inflation tail risk, you might see a modest bump in U.S. real rates and a 0.2 to 0.5% move in the dollar index. None of this is guaranteed, but these are the channels through which Navy deployments affect financial markets. The deeper implication is this: U.S. military posture is now explicitly part of the inflation and energy market narrative. The Fed cares about energy prices because they drive CPI. The market is now watching the Pentagon as much as the Federal Reserve. That's a shift. It means geopolitical risk is no longer isolated to defense stocks and shipping plays, it's a macro variable. Every energy and finance team in the world is now running scenarios on, what if this escalates? What if ships get hit? What if the strait actually closes? The fact that Trump is moving to prevent that scenario is market positive. But the fact that it's being discussed at the presidential level tells you how fragile the supply chain actually is. In India, this matters because energy inflation is a persistent headwind. India imports 80% of its crude oil.